Oh, if there's one thing that could push us into a recession, it's this. We're going to talk about a realistic bear piece from Nick T and the Federal Reserve, which really outlines exactly what our risks to our economy are. Which means if you're invested in risk assets like stocks or even crypto or to some extent real estate, you probably ought to pay attention to this video. And if you make it to the end, I will give you a beautiful drawing that Max made on my notes, as well as a small little update for the channel, which will be pretty exciting for some of the regular viewers. With that said, let's get into the bear talk. So Nick T just reported on another two very interesting pieces. One was a Wall Street Journal piece he wrote. He's, of course, our Fed mouthpiece. In case you're not familiar with him, he's the guy who tends to be the Fed leaker of information. And after he posts something, people are like, okay, that's basically the Fed trying to prime markets for what the Fed is up to. And so one piece was the Wall Street Journal, an article he wrote there. And then a second piece was from the San Francisco Fed that he retweeted. We're going to look at both of these in conjunction. Now, a lot of people wonder, Kevin, why do you bother looking at bear pieces? Why can't you just be happy that stocks are green or things are going okay? Your Nike swoosh recovery is playing out. Why pay attention to the bear pieces? Well, I'm a big believer that if you're not aware of what your Achilles heel is, then you won't see the attack coming and you'll end up being caught blindsided. It's kind of like you don't want risky, profitless companies going into a recession. You have to pivot and dump those. Or if you're a fighter and let's say you're really weak-handed with your right hand, well, then you want to make sure that you're in a position to fight with your left all the time. Okay, bad fight analogy, probably. That's maybe why I should have just stuck with the Achilles heel analogy of if you actually get stuck there, you die. But whatever. Point is, you gotta pay attention to what your weaknesses are so you can position yourself appropriately. And I hate to say it, but a lot of the content that I see on social media is a string of nonsense. I saw it again. Yesterday, I didn't have any juicy Goldman Sachs pieces to read because it was Sunday, so I watched a video, and what did I see in the video? Inflation's at a 40-year high. That's bad. And then this one was even more almost criminal. You ready for this? Let me give you this one. This was criminal in my opinion. Somebody made a video going, U.S. banks are abruptly freezing bank accounts. And it was this basically enticing headline of like, oh my gosh, they're freezing bank accounts. And I thought the creator would potentially look and go, okay, look, here's really what the story is. But no, it was literally title of a video, U.S. banks are abruptly freezing bank accounts. And then the content of the video is, this is why you can't trust the banks. This is why you should only trade. This is why the economy is doomed. And I'm like, good Lord, okay, what's going on? So we do a little bit of looking. And yeah, it is true that Bank of America has had an increasing number of accounts frozen recently, but why is the part that matters. And Bank of America, well, first of all, the articles and the journalists quote that, oh, well, Bank of America says it was shut down, their accounts were shut down, and they refused to give the customer an explanation, basically saying the customer's stuck at the bank with no access to their funds, and now they're in forced poverty, which sounds really bad. But it's not until you actually get 2/3 into the article that you hear that there are actually banking policies that require banks follow up on suspicious activity reports and freeze accounts that may be the subject of fraud. But it gets even worse. When you actually get to the bottom of the story, Bank of America told the news outlet that this particular complainer, that his bank was frozen, actually submitted a fraud report to the FBI, suggesting that a scammer was impersonating them, and then the bank got that report from the FBI, and the bank froze the person's account. But the person who made the social media video suggesting, banks are freezing people's accounts, this is a sign the economy is going to collapse, didn't bother reading past probably the first third of the article. And I'm just thinking to myself, oh, this is a disservice to social media. It's embarrassing. Anyway, look, I wanted to start with this preface. I know it's a little bit of an elongated preface, but I think it's really important because it shows us that, headlines and the things people talk about, they go for beer and they're like, hey man, you heard, Bank of America's been freezing more bank accounts. It's like, Hey man, did you read the rest of the article? No, but people do that all the time. I hear headlines all the freaking time, even from people around me. And I try to minimize that. And I always fight back, but it's hard because it's just the world we live in is just so headline driven. Okay, anyway, so let's get to the Nick T piece. Hopefully you appreciated that extra free bit of perspective in psychology. If you do like that, remember I've got a coupon code expiring in the next 2 days for the programs on actually building your wealth with actual psychology for not just investing in stocks, investing in companies and researching companies, but also the same thing for real estate, going from zero to millionaire in real estate. It's very possible. I did exactly that, and you can too. So let's get started with Nick T. Finally, after like 5 minutes, although I think that was very productive. So Nick T is lamenting that there are two sides of debate right now. One where economists are concerned that easing inflation will be temporary, that basically prices are going to start skyrocketing again and inflation will rise again. And the others say that the Fed is looking in the rearview mirror and they're totally ignoring that price pressures have already started to subside. Now, this is interesting because it sets up a very casual debate. But there's actually more to this, and I want to show you where the real red flag is that could drive us into recession. So, the real red flag actually comes from, okay, not that earnings piece. Hold on a sec. That's an earnings call we broke down. It actually comes from this Federal Reserve Board of San Francisco economic letter. And what I think is really incredible about this, and there's a lot of technical wording in this, so we're going to simplify it, is they make it very, very clear what the real fight actually is. And I'm going to simplify that because if I read all of this out, I'm going to lose you. So let's start simply. First, we know that the prices of oil, gas, natural gas, energy, and a lot of things have been growing at a slower pace or just outright falling. That's good. We've also been seeing rents start declining. That's good. Well, I mean, let me clarify that. Rents haven't actually started declining. Rent inflation has started declining. Very different things, right? Rents declining are like, yay, my rent went from 1900 to 1850. Rental inflation declining is like, yay, my rent only went from 1900 to 1910 as opposed to from 1900 to 2000, right? Anyway, so we've expected and have been watching rental inflation come down. That's great. The part that's left is the non-housing super core services side. We've already heard that. That's old news. But here's the new part. This is the concerning part, okay? So remember, 3 parts of inflation. We're good on goods. So far, we're good on housing, maybe, asterisk. We'll come back to that. And number 3, non-housing super core services. And the San Francisco board piece, which Nick T references, talks about 2 problems. One could be good, one could be bad. Number 1, if you have super core inflation based on what's going on with how much people are being paid for wages and therefore how much the cost of services are going up, like hotels, air travel, very labor intensive, or medical services, financial services, whatever. When those wages go up, those prices tend to go up as well, at least so we've thought. The San Francisco Federal Reserve Board, they suggest, well, we find that core service inflation actually goes up the most with rent inflation. This is a high sensitivity environment. So in other words, rent goes up and all of a sudden, like all of the doctors and maybe the hotel folks or whatever, everybody's raising their prices not because of wages, but actually because rents skyrocket. That was a weird crack. But anyway, that's crazy because, pause for a moment. We've regularly been thinking it's wages that cause inflation to go up. I just started by reiterating that idea. But the Board of San Francisco actually thinks, no, it's rents going up. Okay, cool. So if that's true, that rents drive services inflation, then as long as we remain highly sensitive to rents driving inflation for core services, inflation should plummet because rent inflation is falling. That would be good. That would be called the high sensitivity scenario. That would be very, very good. However, there are 2 really big problems that could come. The first is we go back to what was historically normal, and that was going back to 2019 where we had low sensitivity of rent inflation affecting services inflation. This could potentially not be so good because it could mean that even though rent inflation is falling, core services could keep going up. So in other words, if we want to draw the sort of a couple little sad faces here, a sad face would be either, number one, rent inflation falling, not really affecting, so we'll put a equals does not really affecting core inflation. That would not be ideal. And this, unfortunately, is possible. The other thing that is possible as well, and this is a danger that all of us can track, we could look at leading rental data from Apartment List, Zillow, Redfin, CoreLogic. Every month they give you rental price increase data. And that data suggests that rents are slowing in their growth, which is good. But if for some reason rent inflation goes down and then pops up again, it's going to be a problem. Given that housing is rebounding in terms of housing prices, it is possible that rents could go up again. And so that would also be really bad because either rent inflation keeps going down, but it doesn't affect core, which is bad, or rent inflation actually goes up and it does affect core, which would also be bad, right? So really what you want is you want rental inflation to keep falling and it to affect core. Okay, there's a lot there. Let me simplify that a little bit, and we're going to get back to the Nick T piece here because there are more insights to go. Simplifying this, we need to see core inflation fall. We already know that. We need to see rent inflation stabilize. Now, anecdote, which means it is from my personal research, there is more competition coming for rentals in every single market I go into. But it's not just more competition for rentals. It is also more competition for houses. We are finally, at least in the areas that we are searching for real estate, noticing that finally the supply of homes is starting to rise. That's good. Even though transactions are down, and that has part of the equation of it, 4 months supply, we are starting to hear more realtors talk about, it seems like inventory is slowly starting to rise. Now, is that enough to make for any kind of housing crash where everybody's going to be able to buy the dip on real estate for pennies on the dollar? No, that's very unlikely. However, will it potentially create a more balanced environment where you could finally go buy some wedge deals? Like I teach in the courses on Building Your Wealth, link down below, step by step. A lot of people, by the way, lately have been bundling 0 to millionaire real estate investing, and I was surprised by this, but they're bundling 0 to millionaire real estate investing and the income course, which features AI, the how to make more money and get SH90 done faster with AI. Then I got to thinking about it, and I'm like, but wait a minute. If you actually increase your income before you go into an opportunity to buy real estate, you have more income to buy more real estate, and maybe that does make sense. So I thought that was really cool. Anyway, a little other anecdote. So, keeping that in mind, that we want to track what's going on in rental world, right now the good news is it appears housing inventory both for rentals and for sales is rising, which should be a leading anecdotal indicator that rent inflation will stay low. That's what we want. But it doesn't mean that low rental inflation is definitely going to solve core inflation for the Fed. And that's where we get to the rest of what Nick T talks about. So before we talk about that debate, let's give you a quick update. Right now, we have no SEP coming for the Fed meeting in 2 days. We also know that there's a 99.2% chance of a 25 BP hike on Wednesday. I know this is a little weird psychology, but the Fed is basically explaining this away by arguing they kind of just extended the time frame of doing a 25 BP hike. It's kind of like arguing we did two 12.5% hikes. We didn't stop and start again, like we had the problem of doing back in the 70s, which is really bad. That's at least what they're trying to excuse. Fine. September actually has an 81.5% chance of remaining flat. There's about a 17.9% chance of getting 5.5%, so another 25 pp. Okay, fine. So, now we're caught up. We want to see rental inflation fall. We want to see core inflation fall. We want to see rental inflation affect core. We are kind of separated from wages a little bit. And this is interesting because that's what the San Francisco Federal Reserve Board suggests, is that it's not really so much wages right now. And this I thought was really sneaky. What's on screen now? The last time we heard Jerome Powell speak, he actually suggested that 3% wage growth would be consistent with 2% inflation. That was incredible. And then when we looked at the research, we saw that over the long term, we generally had about 2%, 2.7% wage growth. And it did equal actually less than 2% inflation. So historically, that has been true. But what I thought was interesting here is it looks like they just moved the goalposts. Look at this. Nick T just wrote, officials are likely to see 3.5% annual wage growth as consistent with inflation between 2 and 2.5%. Huh? Wait a minute. Why are we talking about 2.5% for inflation? Why are we talking about 3.5% for annual wage growth? Keep in mind that wage growth over the last year has been 4.5%. June's inflation rate for wages was actually 0.4, which is more than what we've been growing the past year, which annualizes out to 4.8%. So far, wage growth isn't actually going in the right direction, and instead the Fed is moving some of the goalposts. But that's not necessarily terrible because maybe wage growth isn't what matters as much. Based on what the San Francisco Federal Reserve Board is saying is actually rental inflation. And the leading indicators of that are positive. That's good. As you can see, a lot of thought so far went into this. Like, I really try to find those Achilles heels or those, weak hands. Okay, so this then talks about, okay, these different views on inflation. This was a little boring. We talk a little bit about how here wages and the wage market is starting to slow, although I just said this maybe doesn't matter so much. But there's some talk about how the wage gains seem to be slowing. The number of new jobs filled seems to be slowing. The number of openings is slowing. Everything is suggesting we're getting into sort of a smaller or more calm labor market. And we just have to watch now what happens with the rental market. So what I like to do is set the game plan. The Fed right now has a weird license to wait. In other words, we have some signs of softening unemployment, though we're not sure how much that's going to hit inflation. We have signs that inflation is moderating, but we're not sure if core is being sticky. We know that the next labor report is on August 4th. Write that down in your calendar. Next CPI report is August 10th. Write that down in your calendar because it's Lauren's birthday. And this is a CPI report. And then we'll find out in the September meeting, are we going to get another hike or not, probably based on these two reports. We'll also have a summary of economic projections in September. Now, I promised you a picture and some scenarios to bottom line all of this. First, this is Max's picture. He started drawing me a house. I kind of like it with the exception of the fact that it looks like a guy with a really short hairdo, droopy eye, and a sad face. So I'm going to have a conversation with him about the meaning of this house that he's drawing here. Because yesterday we went tubing in Big Bear Lake, and I have to say, he had a blast. He's 5, and he goes faster or tells the driver of the boat to go faster than Jack does, who's 7. Like, Max is like the little brute. Jack's the kind of one you kick in the butt, and he'll go, ow, Dad, why'd you do that? Max, you kick in the butt, and he'll turn around and go, I'll fight you. He's like that little chihuahua. It's kind of crazy. Anyway, we'll have to talk to him about what he's trying to create here. Before I talk about these scenarios as well, quick thing, I'm going to try something. This could be a little wild, but I'm going to try something. What I'm thinking about doing is having this interesting schedule where we basically we do like a 5:20, maybe earlier, public live, and then about 6:25, we do the course live. Okay, ready for it? Around 8 or 8:30, I go live again, and we'll do market, reactions, commentary, maybe politics as well. So it'll sort of be like the midday stream. And I'll actually likely do a lot of this on a different set. It'll give me a little bit more flexibility because I'll actually be in the office with the team while we do that. And then we'll probably fly for real estate after the bell, which, remember, the bell here is 1 p.m. So it actually gives us a really cool time zone hack to still have the second half of the day. So we'll see. I think that's kind of cool. All right, now, let me know in the comments what you think about something like that. But anyway, here are the scenarios. So bad news, this is what the bears are going to say, is that we stay with a strong core and rent inflation doesn't happen. Either it doesn't happen or it just doesn't affect core. This would be bad. However, I wrote house hack, my real estate startup, finally submitted for that Reg A, by the way, so stay tuned. We'll be able to raise funds for that very soon. We're still doing the one-to-one valuation. You can already go to the SEC website and start looking at the filing there, though it still has to be qualified for by the SEC, so stay tuned for that. And then you'll see here that wage inflation does not, moderate more. Could potentially be an issue, though people are still up in the air of what wage inflation is going to do. Obviously, the mid scenario here is moderating core, rent inflation or disinflation occurs, but it stabilizes. However you look at it, around 2-3-ish%. The great would be that core just starts plummeting, and we can keep a strong economy. My guess is that usually things tend to just work out with a middle bias. So we're probably not going to get the best case scenario. We're probably not going to get the worst case scenario. And we can find this. We will see this at House Hack. If we start going in this bad scenario, we will see the rental inflation at House Hack. Not only that, but we'll obviously see those core numbers really destabilize. So we have the indicators to watch for that. So overall, I'm optimistic, but there's definitely stuff to pay attention to when it comes to the Fed, and this is a full outline for you. So if you found this helpful, consider subscribing to the channel, share the video with anybody you think would find this useful, and folks, we'll see you in the next one. Thanks so much, and goodbye. Now, I want you to know this. When it comes to AI, time is what's going to make you money, and if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by